Well, ladies and gentlemen, moving ahead with the next session, that is Building for the New India, Decoding the Biggest Deals of 2024. Our panelists have led some of the largest deals in 2024 and discuss investment opportunities in India that leading investors are backing for the next 5 years. It's time to invite our moderator, Nick Corollo, reporter Bloomberg. Nick Corollo covers Asian credit markets out of Bloomberg's Mumbai bureau. He previously covered American municipal finance and municipal bonds and K-12 and higher education debt. Can we please have a round of applause for him? Warm welcome to you. We would like to invite Ekta Gupta, partner Shardul Amarchand Mangaldas and Company. Ekta Gupta is a corporate M&A and PE partner at Shardul Amarchand Mangaldas and Company and has been with the firm since 2007. Ekta regularly advises large private equity funds, public and private companies, sovereign wealth fund, MNCs, and strategic corporate clients and Indian conglomerates on a wide variety of their complex cross-border PE and M&A transaction. A very welcome to you. Up next, we would like to welcome Ms. Gurnoor Kaur, Senior Vice President, TA Associates. Gurnoor is focused on investments in business services and technology companies in India. Before joining TA, she gained valuable experiences at Rothschild and Company, where she worked in the investment banking division, handling sectors such as telecom, energy, consumer, and healthcare. Can we please have a round of applause for her? Please help me welcome Karishma Makhija, Director, Motilal Oswal Alternates. Karishma joined Motilal Oswal Alternates in 2021 and is responsible for transaction sourcing and evaluation, financial analysis, deal documentation, and portfolio management. She has 15 years of experience across private equity, M&A, and investment banking. She has successfully executed several notable transactions, including private equity investments in SK Finance, Happy Forging, AUSFB, TransUnion Sibyl, India Shelter Finance, and acquisition of Micro Housing Finance by Swatantra Microfinance. Can we please have a round of applause for her? Up next, we would like to welcome Rochelle D'Souza, Managing Director, Lighthouse Funds. Rochelle co-leads the investment team at Lighthouse and specializes in food, healthcare, and agri sectors. Ms. D'Souza's current board position is including Tynor Orthotics and the largest orthotic soft good company in India. Wow Momo Foods, which is India's largest homegrown QSR brand, and V2 Retail, a leading value retailer. And last but not the least, we would like to welcome Ms. Sakshi Gera, Director, Kedara Capital. Having 15 years of investing experience encompassing the full life cycle of private equity in India, she leads Kedara's effort in technology services, where she has led and advised on US 900 million deployment by Kedara in the space. Can we please give them all a huge round of applause? Ladies and gentlemen, a bigger round of applause, please. Warm welcome to all of you, and we are looking forward to it.
Well, thank you all for sticking through for the late in the day panel, and thanks to the panelists for joining here today. My name's Nick. I'm a reporter with Bloomberg News.
I'm sorry to interrupt, just a minute. In case anybody has any questions, we'll be requesting them to please write it down, and you may connect with the jury and the panelists post the session gets over. Yeah, thank you so much.
Super. Well, we've heard a lot about private equity today. I'm going to try to carve out a little bit more specificity here. We have some really great panelists who've worked on some really big deals over the last year, and it's been a busy year for Indian private equity. I thought we would start off a little bit broadly to kind of set the scene. Rochelle, maybe you could kind of give us your broad sense of the macro landscape in India right now, and what does it kind of mean as you're pitching investors to put money to work here?
Hello. Thanks so much. Am I audible? Yeah, perfect. Thanks so much for the question. I think in the interest of not being repetitive with respect to how great India is, I'm just going to skip on that part of India's splendid. But when it comes to the investment strategy with respect to my firm, which is Lighthouse, just to give you context, we are a mid-market private equity firm. And we invest anywhere between, say, 25 million to about 80 million in companies which are in the mid-market space where the revenues are anywhere between, say, $50 million to $200 million. And we only take minority stakes. So the context is a little important to sort of understand where we invest. The two sectors that have been pillars for us is consumer as well as healthcare. Now, when we think about the macro landscape, we think about it from every fund cycle. So the investment strategy that was relevant, say, in Fund 2, vintage 2014, is very different from the investment strategy that we're doing for Fund 4, which is vintage 2024. Now, if I just take a thread within that, say, consumer, for example, right? Our investment strategy in 2014 was very broad-based Indian consumer, where it was more affordable, middle income, so it was more mass market brands, unbranded to branded, unorganized to organized, so on and so forth. But if you try to apply that same landscape to what it is today, it's very different. The Indian consumer is extremely different. So we've gone from being a very mass market brand-oriented strategy to something more discretionary for Fund 4, right? So we're looking at more use cases where it's more premiumization, so on and so forth, right? So the landscape has completely changed. And with respect to how the pitch evolves as well for our own investors is actually helping them understand as to, along with the fund, India is evolving, the Indian consumer is evolving as well. And so the strategy needs to evolve. So our deal sizes have evolved to that extent. So where we used to do the 10, 15 million, our deal sizes have now increased to 25. Our last deal was about 80 million in size. So happy to talk about it in further detail, but I think the takeaway is that the strategy doesn't remain the same. It sort of evolves with the fund cycles, and happy for other panelists to sort of add in as well.
Gurnur, maybe we could pivot to you. I'm curious, if you've kind of seen a similar trend with regard to deal size, and if there's any specific sectors where you've really seen, development in activity.
Hi, can you hear me? I'll build on to what Rochelle said, and maybe I'll also give a very quick background about TA to set that context. TA is a global fund. We're managing close to 65 billion of capital, currently investing out of our 15th fund. We're agnostic between minority and majority, and we invest between a range of $100 million to, say, anywhere between $500 million. A lot of what we've done in India over, say, the last 2 to 3 years would be in the buyout space. And I say that because it's been a function of the check size that you're investing and the depth of the market. I've seen a lot more activity, not just for TA, but across funds in tech services. There have been a bunch of large deals, including an Altimetric, Impetus, which Sakshi led, in that space. There's been healthcare, which has been of interest. You've had Healthium. So a lot of large, say, $500 million to $1 billion transactions that have happened in these two sectors. The third sector that comes to my mind is financial services. If I think more futuristic, I do expect tech services as a function of macros, wage inflation, just the way the macro will pan out in terms of inflation, etc. That's a sector that will benefit because it plays on the outsourcing theme. Similarly, healthcare, there's just so much to do, especially in a market like India. You see super specialty, you see a bunch of other smaller subsectors within healthcare that are growing very nicely as a function of fundamentals. And the third piece, I would have a similar view on financial services. So that's my overarching view.
Just to follow up, could you talk a little bit more about some of those subsectors in healthcare where you're really seeing some growth in activity?
I think I would talk about super specialty. One transaction that TA did was in the IVF space. We invested in the largest IVF chain in India called Indira IVF, which we sold last year to another private equity fund called Equity. I'm seeing a lot of activity across different stages of investment, and by that I mean buyouts, growth, in the fertility space and women health space. That's something that we're excited about. Outside of that, there's been a bunch that's happened on multi-speciality hospitals. At least that was the theme in 2024. There's a lot happening in eye care. There was Appasamy. There are a bunch of other sets that you're seeing, again, focused on solving a very niche specific healthcare problem, is what I'm picking up.
Ekta, I wanted to pivot to you. You know, one subject that came up a bit earlier today was this regard of exits. You know, do you get the sense that it's getting easier for investors to exit? What are you seeing this year and last with regard to the volume of exits? What is the mood kind of looking like here in India?
If I look back, audible? If I look back at 24, it's basically been a bonanza year for exits, really. The theme for the year has been exits in terms of either IPOs or buyouts or open market sales in that sense. In contrast to investments, investments was not the theme. People were sitting on capital, and a bunch of factors led to sort of exits being the theme rather than investments. Most importantly, of course, at a macro level, you had the political and geopolitical factors around uncertainties continued around China, Ukraine. We had the elections in India. We had the elections in US. All these factors led for the investor community, at least in the first couple of quarters, to sort of sit back and take a quiet position, wait and watch. But at the same time, the capital markets were booming, and companies, founders, they were looking to tap on the higher valuations that are available, and therefore the focus was go public, tap the higher valuations that are available, and that led to, of course, listings and buyouts in that sense. But having said that still, now that we're sort of wrapping up 24, we're already sort of seeing green shoots of those private conversations or proprietor conversations already picking up, because in the last quarter, capital markets have been down, which means the private sales should pick up again and pay way for the money that the PE has been sitting on for the last 1 year or so. But in contrast, the only other limb I'd add is, while PE was nimble, the theme I felt was the focus was more strategic transactions, more consolidation. So M&A was not so nimble in comparison to PE, with themes, of course, being around sectors such as infrastructure, healthcare, as Gurnoor already mentioned. Yeah.
If I may just add to that, and Nick, and agree with everything that Ekta mentioned. We at Kedara, we did the IPO of Vishal Retail, which was by far the largest consumer IPO, and it led to outcomes that we also did not imagine will happen, fortunately. But the markets are maturing now. The domestic mutual funds are lifting a lot of burden and underwriting a lot versus dependence on, the anchor foreign institutional company. So to that extent, there's a lot of retail, there's a lot of mutual fund subscription, which is helping a lot. Indian markets are maturing, so there are companies which are taking the bets of flipping. Hexaware flipped from US to India to list in India, actually, and paid the taxes even before they could list. So to that extent, there's a lot of, it will ebb and flow, but I think now people do think that Indian capital markets have come to an age. We had never heard of $1 billion blocks in the country. Those are happening a lot more in tech services, whether it's Hexaware, Emphasis. So earlier, when we used to underwrite, we used to think that IPO, yes, sure, an IPO can happen, but now that's a reality, and that's a sign of how the markets are maturing.
That's really interesting. Can you talk a little bit more? What is the calculus of a company that might be considering flipping an IPO in that way, coming to India time?
Yeah, so I think, there are a lot of pros and cons. You almost, for a lot of tech services companies who are headquartered in US, they have to pay almost an exit country tax, right? And you have to pay it before you list. But the valuation arbitrage is huge in terms of you can really get anywhere between 5 to 10 turns of multiple extra. Plus, a lot of times, and maybe speaking more for Kedara, we invest in mid-market companies, right? You invest in a company which is 200 million, 250 million in revenue, you hope to get it to 600, 700, and then do an IPO. So a 600 million company on a NASDAQ will be lost. So to that extent, Indian markets provide that leeway in some way to rise and shine in those markets and still depict sort of the growth margin story very well.
And if I may add to that, I think Ikta and Sakshi covered public markets, but I would also like to emphasize on how the avenues for exit for private equities has expanded. We are a lot more open-minded to trading assets between funds, and we've seen that as TA, we've really warmed up to that over the course of our 10 years in India. There are just more avenues to exit now versus there were, say, 5 years back.
Yeah, and I just want to add to that. So we at MO Alternates, so just to give you a background, we do minority stage investments ranging between, in our earlier vintages, we used to do 15 to 25 million of investment check sizes, and right now we're doing also like 40 to 80 million, wherein we do stakes between 10 to 40%. What we've seen is, historically, our first two vintages, we would exit via, say, IPO. So 55% of our exits were through IPOs, and then we had strategic sales as well as some buyout kind of transactions. Now what we're seeing is the kind of liquidity that Sakshi also alluded to. Markets have deepened considerably, and we're seeing that our current portfolio and going forward, our fifth fund, we would have exitability of between 60 to 70% would be via the IPO route, given that retail participation has just snowballed over the last 2 years, and we don't see that stopping today.
Just to expand on that a little bit, Krishma, I was wondering if you had any broad takeaways from some of the big IPOs last year and where you see the IPO market headed going forward.
Yeah, so IPO markets is something which is close to us as a fund because we are housed under Motilal Oswal Group, which has had 40 years of an investment experience journey. So a lot of our investee companies also benefit considerably from the, just about timing the market, knowing a little more about what's going on in terms of which sectors our research teams are covering, and what's the flavor of the season or flavor of the next decade. So I think we add that knowledge a lot to our portfolio companies. But just zooming into the last 24 months and more so the last 1 year, if you see, of course, 24 was a record year for India, the Indian public markets. Companies raised around 20 billion of capital via the IPO route. This number, if you compare it to 2015, which was companies, there were around 16 companies that went public raising close to 2 billion. 2019, you had close to 3 billion getting raised via the IPO market, and now we're talking about 20 billion getting raised via the IPO market. So definitely Indian public markets have broadened considerably, deepened in a real way. We don't see this exuberance ending here, given that if you see quarter to date, year to date for CY25, you've had 1.5 lakh crore of capital getting pulled out by FPIs, given the uncertainties that Ekta alluded to around geopolitical crisis, tariffs by the US, and there's a lot that has happened from December to now. Overall in the global economic scenario. So FPIs are definitely jittery about emerging markets, which is where they're pulling out capital from India. But at the same time, year to date 25, you had 1.8 lakh crore of domestic pools of capital flushing into the Indian public markets. So the retail participation that has happened from 2019 to date has only given confidence to companies and investors like us that this is not a temporary liquidity phenomena. It's not the last 3 years or the last 2 years that have benefited companies and private equity investors such as ours. But surely markets have softened right now, so valuations are more realistic. What this tells us is that when you're investing in companies, you need to underwrite growth. like we do at Motilal Oswal Alternates, we really don't look at multiple expansion as a criterion for looking at exit IRRs at the time of our investment. So if you are backing companies which are high growth businesses, earnings growth is visible, then you will still have takers for those companies in the public market. So yes, good quality companies, high governance companies will still have demand, given that there's a lot of capital coming in from domestic investors. So shortage of capital is not going to be a criterion, I would say, when you're looking at exits. Again, we as a mid-market stage investor, we are very well positioned from a standpoint that we could have larger global investors or domestic investors who could take in, come in the next round through a strategic or a buyout stage kind of investment. At the same time, we could take companies public. But private equity investors such as us, we are not really worried about what's going on currently. Looking at the next 3 to 5 years, we see retail participation only increasing year on.
I can just add to that a couple of points on IPOs. What's promising and interesting about the IPO, how it's sort of been unprecedented in the last year or so, is it shows the broad basing of the expansion of the money coming in or who's participating in that. It's not just limited to PE. You see now a lot more retail investors and a lot more sort of your domestic mutual funds or the DFIs were a part of this IPO broad basing, which sort of gives it more stability, and there's not just reliance on the FPI money in that sense.
Sakshi, I wanted to mention something that you mentioned to me earlier, which is this idea that Indian private equity is starting to see this trend of growing operating individuals. I'm wondering if you could just explain what that means a little bit. This is a concept that's a bit more familiar maybe in markets like the United States. And what does it mean for someone in your shoes?
Sure. We as a firm at Kedara, we do believe that the Indian markets are maturing. And by virtue of that, there is more buyouts. We are willing to write more transformative growth stories. Now, how do you, as investment individuals who've mostly never run businesses, do that, right? So there is a lot of trust in getting people who've run businesses, who've underwrote that transformations, who we can really learn from, right? I'll maybe share 1 or 2 examples where we've seen this was beneficial. So Impetus, which is a deal that Kedara did, it's a $370 million deal, large tech deal from that perspective. How do we underwrite margin expansion? How do we underwrite go-to-market improvement levers? We had 2 operating individuals, Abid, who used to run Wipro till 2020, and this gentleman called Chris Baker, who used to run a company called SoftServe and scaled it from 150 million to 800 million. So these 2 people jointly, literally co-underwrote our plan, which gave us a lot of comfort to position the company and say what we can get to in the next 5 years, which we would have been flying a little bit blind without their guidance. You would have triangulated from other comparables, but that really lends a lot of credibility. So in a lot of large buyout deals, we've seen almost an investment and an operating team jointly underwriting the model. And then they're also responsible as deal advisors, board roles to deliver on some of those roles. So now they are more and more joint at the hip versus earlier. Another example at Kedara, we did this investment in Dairy Day. We as a fund had made up our mind that we don't want to look at ice cream, supply chain doesn't work. But then we had Vindi Manga and Nitin Paranjpe, who used to run HUL, right? And they said, no, you're wrong. You should look at this business. It does deliver a lot of strong economics. And as a result, we ended up spending time investing in that business. And now these individuals are very actively playing the role in delivering some of the outcomes and the value creation levers that we underwrote. So I think investing is one piece, but a lot of private equity art is creating the value, right? And that can't be done without the operating involvement.
I'll just add to what Sakshi said, because this aspect of operating partners, while it was very prevalent in the US and more so relevant for the buyout funds, increasingly as minority funds, we are realizing that is also very important. So when we were in our Fund 2 vintage of 2014, we didn't have any operating partners. It was just us who were taking capital to the founders and saying, hey, Lighthouse is willing to write this check, and so we'll come on board. But today, like you all mentioned, there is so much capital that's out there for each of the founders to take. As minority funds today, we are thinking about how do you differentiate yourself to that particular founder. And so it's not just as investing partners, we as Lighthouse or Motilal or whoever it is, has to earn their stripes. And so operating partners become even important from a minority construct as well. So giving you an example, we're talking about large deals right now. Last year we closed an 85 million deal, large in this context for us. It was the largest for us in the history. But the reason why we were able to sort of back that particular deal, it was in the food contract manufacturing space called Parsons, is because it was this whole conjunction of investing partners who had done about 10, 12 years of consumer investing, but at the same time operating partners coming from HUL, from P&G, who understood consumer through and through, and were able to talk the language of the founder, and we were able to understand the pain points in contract manufacturing at that point. Not a very sexy investment area to look at, right? Because it's so back-end, it's so CapEx heavy, but still we had the operating partners saying, look, it's an interesting space to be in. You don't need to give 10x revenue, but you can give 10x EBITDA, right? That's the sort of conversation to be had. But to Sakshi's point of operating partners, I think it's added a lot of value to minority strategies as well. So I think it pretty much goes through and through.
Yeah, I think a lot has been said, but like Rochelle mentioned, it's increasingly important for private equity investors, even looking at minority stage investments, to differentiate themselves. Today, as companies are getting matured, for them, capital has become commodity. That's the reality today. So what is a private equity investor really adding value to the company is what a promoter is seeking. So we also, we do 10 to 40% stakes, but we have a 5-member team who only looks at spending 100% of their bandwidth with portfolio companies. The example that Sakshi mentioned about Dairy Day, that's been one of the companies that we exited to Kedara. And there was significant value addition that we did with that company as well. So this company in the B2B2C space in the ice cream industry, they did phenomenally well post our investment in 2016, and COVID hit, and 2 years of 2 summer seasons, which is 60% of their business, was the time where COVID coincided, and they lost a lot of business. There was a degrowth. And our operating partners team, they jumped in, helped the companies rationalize loss-making to profitable freezers where they sell their products, and were able to help them source better in terms of raw material. And there was a 1.5% improvement in EBITDA margins as well during this phase. And the outcome was phenomenal. We exited this company with close to 5x returns. At the same time, there was a significant value addition in this company, which was a representative for other companies that we were evaluating. So recently, we invested in a confectionery brand called Lal Sweets. It's in the packaged sweet space. And they had 3 other competing bids, but we came in at a cheaper valuation versus our bids, given the value addition that Motilal Oswal team has added to companies in the consumer space and other sectors as well. So it is becoming increasingly more important. We add value not just on the business excellence side, but we also have operating partners on technology improvement and building in a second in line with respect to building on the human capital of the company. So that's been our focus as well.
And I think there's a lot of value add that operating advisors add, operating partners add, but even outside of that, value creation can happen in the form of just setting up systems and processes, especially around finance, sales, etc., for a second generation business that a private equity is coming in. I think there are mini consulting projects that a private equity could take up as their own outside of that operating partner network, which at least TA has benefited from.
Rochelle, I wanted to pivot back to you and see, Hector brought up this point of kind of the growth of retail investors. I'm curious
if you're seeing any shifts in where investor appetite is coming from and what you kind of expect some of the sources of new capital to be.
Look, I think I'm going to borrow Modi ji's line of Atmanirbhar Bharat, which means self-sufficient India. We are becoming self-sufficient India from a capital perspective. What I mean by that is, when we used to fundraise in the early 2010s, there was no way you could have thought of India as an avenue for, or a large avenue for capital. I think Motilal has done a phenomenal job at tapping it, but we could not think of it, right? Almost all of our capital came overseas from different pools, for instance, institutional capital, family offices overseas. But I think in the last 4 or 5 years, that situation has completely changed because we are seeing a lot of domestic capital formation. Why is that the case? It's because founders themselves have been able to realize a lot of monetization, right? And so a lot of them have set up family offices of their own. So there is a lot of capital that is moving into the alternatives. So private equity funds like us, even in our current fund, we recently closed Fund 4, almost 30% of that has come from domestic pools of capital. Insurance firms in India, 3% of that can go into alternatives, and they have not even scratched the surface, and 3% goes into a few lakh crores, right, of their AUM. Now that has not even come into alternatives, but it's increasingly coming into alternatives. So we see a lot of domestic pools of capital that are going into alternatives. The flip side to it, however, is that as private equity managers, we need to think about return of capital. So as long as the vintages are able to give a DPI, back to these investors, that capital is going to come back in. So the litmus test is now, because a lot of capital has gone in the last 4 or 5 years. Will that come back to the investors so that they can put back the money? I think that's a question mark. And I'm assuming with the growth of managers and how we are investing right now, we should probably be on the right side of it all. But that's one of the pools, and I would ask the other panelists to talk about the other pools as well.
If I can add to that, of course, not taking away, and their last couple of years have definitely shown the amount of domestic money that's coming in. But what we've also noticed is in the last couple of years, there's a fair bunch of sovereign investments from the Middle East and various other sovereign investments that are also coming into India. Sure enough, they invest in more sort of conventional, traditional sectors, say infrastructure and the like, but a steady pool of money is coming from sovereign wealth funds as well.
Just to add to what Rochelle mentioned, so yes, as a platform, we have really significantly benefited from raising domestic pools of capital and capital from Middle East investors as a house. We itself have a wealth management business which manages close to 16 billion in AUM on the wealth side. Having said that, from an institutional investor perspective coming in from overseas, I would say I would bucket these investors, the pre-2015 era investors and post-2015 investors. 2008-10 was a period for India where there was too much of institutional capital chasing private equities. I think India and private equity investors were not ready yet, and which is where, cut 2015-16, where liquidity became a challenge and DPIs were not getting delivered. You have that set of investors who are still scarred of their, investment and returns, lower returns that they've made out of India. So those investors now have started looking at India much closely. And that is also to do with the fact that China is dried up in a way, barring public markets, which is seeming exciting currently given attractive valuations. But you do have investors sitting out of Asia who are looking at least having offices in Asia, looking at India closely, who want to deploy an emerging market, and India being the largest population and the kind of returns and liquidity created by private equity investors is something that investors are appreciating and now want to start deploying in India. So guys who have been away, given that they invested pre-2015, are now coming back to investing in India. And in terms of another set, in terms of region, I think Japanese investors are interestingly finding India more and more attractive alongside with Australia. So Australia is more the buyout side and India more so mid-market and buyout stage investing.
I'll just maybe take 30 seconds more, just add one more flavor. I think while there is a lot of capital from various pools in various geographies, the outcomes for different funds are very different. These are very savvy investors who are now saying, are you top quartile fund after fund? Did you have one fund flash in the pan return, but is your second fund the same, third fund the same? So I think they've also, I would say, really looking deep down, and the outcomes for all the fund houses in India may not be the same, even though the influx and inflow of capital is really large.
Yeah, I just want to double down on that point around China. When you zoom out and think about Asia Pac as a market, China and India were two growth markets, and everything that has panned out in that region over 2022, 2023, and last year, there has been an inflow towards India. There are a lot of private equity, global private equity funds and APAC funds, which are drawing a lot more attention to India now. And I think that's one reason that you're seeing everything play out in the way it is.
Well, we have about 3 minutes left, so I'm maybe just going to ask to go quickly down if you have a specific closing thought or maybe a particular deal from the last year that sticks out as particularly unique or challenging. If you could just kind of quickly summarize to close up.
I'm not going to talk of a specific deal, but I'll talk of a specific challenge. And the challenge is deal making in this environment, right? And I think a lot of my fellow panelists will empathize, is because on one end, we are harping about the IPO markets and, everyone is able to exit. The flip side to that is, I am losing a lot of my deals to the IPO markets, right? So we spend years together baking a lot of these relationships with the founders. But if the IPO market is willing to give you 30x EBITDA, when you are only able to underwrite 15x EBITDA, there is no competition, right? You have to tell the founder, please go ahead and do your deal in the IPOs, right? So I am, the last year or so, a large part of it, we didn't write a single term sheet, is because we were not convinced with those peak of valuations, right? So right now, even though my personal portfolio has taken a massive beating, I am feeling really happy about it because at least there is some sanity to the valuations. And what do I mean by that? If you look at the index, you're not going to say that it has fallen too much, right? 15-16% correction. But there has been massive sort of correction in the if you look at the constituents of it, right, where 50-60% of the companies have corrected 50-60%. So my closing thought is that very challenging environment. There is a lot of capital, color of the money is green at the end of it. So how do you differentiate as a deal maker becomes very important. But excited that the valuations have sort of, there is a certain, sanity creeping into the valuations. And I hope that that continues so that then there are more deals we can talk next year.
Gurnur, how about you? Any deals that stick out in your mind?
I'll be yin to Rochelle's yang. I'm very positive on how businesses are shaping up. There are a lot of second generation, third generation founders who are welcoming institutional capital and a way to just institutionalize their businesses. Fundamentals are thankfully holding up. There's just a lot more focus on profitability within the tech ecosystem, and all of that will hopefully lead to incremental deals for all of us to do. I'm taking a more 5-year, 10-year view of the market where I expect a lot of capital chasing even more interesting businesses.
So in terms of deals that we've done and emerging trends that we've like to back in our fourth fund, which is a $550 million fund, has been just double clicking on subsectors. So one is on the nutrition, sports and nutrition side. We we led a round alongside with Chris Capital in this company called HealthCart. It's the largest sports nutrition and wellness platform today in the country. It resonates very well to our investment philosophy of backing a first-generation entrepreneur business as well as new age business, which we've done a lot in our fourth fund. So I think sports and nutrition as a category is something that we are very bullish on. We led the round. We did a 50 million check in a $150 million transaction. The other segment, again, which is promising for us over the next decade or two, is been from unorganized to organized, wherein consumers are preferring items which are more hygienic in nature in a packaged form. So we've seen success of BKG play out in the snacks category. Packaged sweets is a newer category where we've backed this company. So we see that this is a sector or a sub-segment which is promising over the next decade. And the third piece is electronic manufacturing. We as a fund have had several successes in backing companies in the electronic manufacturing space. We've backed companies such as Dixon when they were 30 million in valuation, exited at a 16x in the company. Today it's a $12 billion enterprise. We've really been able to successfully identify these gems early on in their growth journey. And that was in our first fund. We've also backed Minda Industries, which is again a multi-billion dollar business. In our fourth fund,
sorry, if you could just kind of wrap up
yeah,
your
sure.
thought.
I'll just take a minute, half a minute. So electronic manufacturing is moving a lot from China to India, and sub-segments like auto components, electronic manufacturing, building materials are segments in the space that we've backed, and we would like to continue backing that subsector.
Well, thank you all so much for your time. Sorry we didn't get to everybody on the last question, but thank you so much.
Thank you.
Thank you so much. Before you leave, I would like to invite Ms. Pooja Sondi, partner, Shardul Amarchand Mangaldas and Company, to please join us on the stage and give away the memento for being here. Could we please have a round of applause for all the panelists on board? And I humbly request everybody to please stand up and have a picture together so we can capture some lovely moments to carry forward in the memory lane. Thank you. Can I request you to please join them in the frame and have a picture before we bid adieu?